Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. Today, we have the privilege of having Adam Patti as a guest on the show to speak to how to select an ETF for investment. Adam is a true ETF insider and pioneer in the industry. Recently, Adam co-founded Vistashares ETF, which he is the CEO of. Vistashares ETFs are designed to provide pure exposure to disruptive technology-driven super cycles. Adam, welcome to the show.
Thanks for having me. I appreciate it.
So there are now at least 24 artificial intelligence themed ETFs. So I'm going to call it now AI. So AI themed ETFs in the market, including one recently launched by Vistashares. So congratulations on that.
Thank you.
What I would really like to get to the bottom of today is how to differentiate between them, particularly how these strategies make decisions on what they own. Before we get to that, so everybody's got to listen a little bit longer, I really want to take a step back. That's the goal of the show. But first, I really want to know, you're an industry veteran. You got into the space early, so kudos to you. And you've done some great things, great innovations. Can you provide a brief insider's history of ETFs?
Sure. I mean, the ETF, the first ETF, of course, was the S&P 500, the SPY, which I think was launched in '93. And it was interesting, it was they almost kind of came across the ETF structure by accident. And it was the American Stock Exchange, where it was listed. And they were working with a woman named Kathleen Moriarty, who became the Spider Lady because she launched the first Spider, but she was a brilliant lawyer, no longer with us, unfortunately. But they launched this product, and it was just really interesting because they didn't really know what they had when they launched it because it was brand new. It was a new innovation, and but it had it was the the 40 Act structure like a mutual fund. But it traded like a stock. It was fully transparent, and it was lower costs. So, I think once they got that to market, they realized, wow, we've got something here. And it took several years before the ETF market even became a market. It was the SPY for a while. I joined the industry in '01. We launched a product called the Fortune 500 ETF, which was the Fortune 500 companies in an ETF structure. But even back then, I forget exactly the number of assets in the market totally, and maybe there was 50 billion or something at that point. So the industry didn't just come out and explode onto the scene. It took many, many years for investors to get comfortable with the structure. And even back when I started a company called Index IQ in 2006, we focused on liquid alternatives, trying to be innovative. But even then, when you talk to advisors, most of the meeting was talking about the ETF structure itself, the benefits, the weaknesses, how to trade it, and things like that. So even back, that '06 to kind of 2015, ETFs still were not, what they are today. I mean, I think there might have been $1 trillion in total ETF assets back then. And that, over the last 10 years, though, it's absolutely exploded. And it's great to see because ETFs, if ETFs were launched, there shouldn't be any mutual funds. Mutual funds wouldn't exist if ETFs existed at the same time. It's just a superior structure, in my opinion, for investors.
Yeah, thanks for that. And, I'll add a little to it in that my first job was in '96. I was hired into a specialist firm on the American Stock Exchange. The first place I stood on the American Stock Exchange, they actually had a mezzanine that overlooked the whole floor. So it was really cool. I was right to the left of the bell ringing. And behind me was the SPY. It was right behind me. And I remember there were a couple, I didn't know what the hell was going on because I was brand new. And I remember, I'm not going to name the broker, but I remember there was one broker that specialized in it. He'd run by and I'd be like, what the heck is going on over there? And to your point, like, it wasn't a main attraction.
Mm-hmm.
98, 99. I think State Street came back and they were going to maybe do selects. I don't know, remember what was next, but I actually sat in on some of those meetings and, this is not good for me, but I was like, what I don't get it. And I was early in my career. It was 2, 3 years in, but I grew up in options. So it's interesting. To your point, that takes forever. I want to pull on the ETF structure. It took some time. People really some of that excitement that came over time was this access, this capability to access it. It almost felt like a stock, and then you mentioned tax advantage. Could you speak a little bit more to some of what kind of got ETFs off the ground in terms of those structural advantages and structural benefits of ETFs versus mutual funds?
Well, I think really the first kind of point that investors really gravitated towards was the low cost, right? So if the SPY is, I don't even know what they charge for it now. Is it 5 bips, 9 bips, whatever it is? It was always quite a bit cheaper than a corresponding index mutual fund. So I think they were trying to differentiate in the early days based on that. Now the tax advantages are extremely important, particularly in a higher turnover strategy. So the SPY is it's fairly low turnover, so the advantages aren't as pronounced. But because there's no it's in kind creation redemption, so there's no pass through capital gains on portfolio turnover. So that when with a higher turnover strategy, that can become significant tax alpha for investors. So I think that's becoming even more pronounced now. Now that some of the more active ETFs are taking center stage far more than they had been in the past.
Yeah, and I'm realizing right now that I want to take a step back here for a second. So you have the S&P 500. The S&P 500 is put out by a firm called Standard & Poor's, and it picks some of the largest U.S.-based companies in the world that you've all heard of, Amazon, Apple, etc. And it creates a market cap based, so based on the value of the company, it selects 500 of them. So as an individual, as a retail individual, let's just say you have $1 million, and you'd have to go and buy, if you wanted to just buy the S&P 500, you could buy 500 individual securities.
Mm-hmm.
And then at some later point, you could buy a mutual fund, and that mutual fund, instead of having a general focus on the market, and we're going to get to passive and active with Adam shortly, you could say, I want this mutual fund just to buy the S&P 500 because I like what Standard & Poor's does, and it feels very quote unquote passive. They're just making a very easy formula. They're picking these 500 names. They reconstitute it. People aren't even thinking about reconstitution, so I'm going to keep it out. They're just picking these 500 big names in the S&P, and that's it. And now I could buy it with one mutual fund. And that, Adam, I'm going to guess, and you could correct me because it's totally off the top of my head, maybe that cost a half a percentage point to a percentage point to do in the mutual fund world. And depending how much money you invested, it might cost you more or less. You think that's fair back in the day, in 1993, maybe even
You're
more?
right. I think you're right. I would love to, actually, it's an interesting point to look at, but I bet you're right. It must have been 50 plus bips for a typical index fund, if not higher. Particularly, maybe not at a Vanguard or whomever, but certainly, your average mutual fund shop with index funds, sure, it was at least 50 to 75 basis points.
Right. And then you'd go and you'd say, I want to buy it. And you'd buy it at the end of the day. You couldn't
Right.
buy it during the day. If you want to sell it because all of a sudden, like something happens in the morning and you're like, I'm out, you have to sell it at the end of the day.
Yep.
So, so now it got State Street flipped it on a head. They said, forget the 50, 100 basis points. We're going to charge you 9. So 0.09%, which is really cheap. And you could buy it whenever you want, whenever you want. And here you go. You have S&P 500 exposure whenever you want during the day. Think of it as buying Apple. Think of it as buying any other security you want or selling any other security you want at any point. And so I think that kind of defines the structural advantages, but I wanted to step back and kind of hopefully get anybody who doesn't have an appreciation of SPY, because now it's just part of the world. And it's been part of the world for 30 years, but this is like a huge innovation. The first one, right?
Yeah, and it really democratized investing because it gave the power back to the investor. Like what you were saying, buy at any time during the day or sell. Now, I don't promote market timing, and
Me
most
neither.
investors cannot market time. But if you see the market crashing, you want to get out. you can get out and not wait to the end of the day and take all the losses in theory, which is, important.
Okay. And then when you were kind of kind enough to give us that background on the industry, you then went from this very broad exposure, and now you kind of started getting into more targeted exposures. Is that right? Right? Basically, you went from that to, you mentioned the tech I think you Fortune 500, sorry,
Yeah,
exposure.
the Fortune 500 was the 500 top companies by revenue, because that's what the Fortune 500 is. So, yeah, I would always try to sell against the SPY. We were just the index provider. I ran Fortune indexes. It was State Street actually that issued the FF. It was a triple F. But I would always tell people, like, the S&P 500 was never launched, was never developed to be an investment product. It was developed as a market indicator by Standard and Poor's, which was a publishing company, just like the Fortune 500 was the top 500 company revenue, which is Fortune is a publishing company. So it was very similar. And of course, it didn't. The sales pitch didn't work because S&P has done just fine with their 500 product, and there is no Fortune 500 ETF anymore. But it's a truth. It was never developed. No one designed the S&P 500 to optimize core equity exposure for investors. But here we
That's
are.
right. Yes, that's really interesting. So here, right there, you have two different ways of gaining exposure to broad U.S. markets. One way, which was based on the S&P 500 index, and I'm just going to define index is, I'll call it a recipe, right? So it says this is how you make it, and this is how often you kind of reconstitute it. And what I mean by that is they say, okay, today, what's the 500 largest market cap stocks? Great. A quarter later, okay, are they still the same? Okay, let's change the exposures, and then add them in Fortune 500, did it based on revenue instead. And there's a kind of some quirks there where it's not quite that simple, but it's close, right?
Yeah, and actually, the Fortune 500 outperformed the S&P 500 over most time frames with lower volatility and higher dividend yield,
There you go.
just because of
That's
the way it was weighted. It was
right.
interesting.
But it didn't win out, and that kind of goes back to the Betamax versus VHS
Yes,
argument, right? Like, not
absolutely.
the best product always wins. But here, if both of them were still around, and there's others like it, now there's a benefit, which is an investor could decide, do I want an exposure based on largest market cap, or do I want an exposure based on largest revenue, or do I want an exposure in some other way? And so on some element, there's this huge benefit in that you have access to all these other strategies. And then there's a huge detriment in being like, how the heck do I figure out which of these, if you even know about them, right? You might just be like, I've heard of SPY, I'm going to invest in SPY, I'm done, life's easy. Or you might say like, oh, well, now what do I do, right? And that's, by the way, some of where we come in, right? We're an outsourced CIO, and help people make decisions like that. But I wanted to do this more with technology, right? So in terms of like, well, let's just stick here. So there's just a million varieties, right? And then you could go, you have passive. Adam, can you maybe give an example of where you go? We use two examples. It's fine to add more in terms of revenue based versus market cap based, or you could just live there. But now kind of go down a little bit into active. You brought up passive versus active before. And just like, how does active differ? Like, give us an example of an active based US large cap strategy.
Well, I mean, I'm trying to think of the tickers off the top of my head. There are certainly a
Yeah, it's not
number
even
of
bother
them.
with tickers, but yeah.
Yeah, okay. But
Yeah.
there's certainly a number of them. But I would almost carve up the world by index based and non-index based, because this was a big back and forth with the SEC many years ago, where you know if you're designing an index, you're making active decisions to create that index. You're overweighting, underweighting, you're carving out certain SIC codes, you're ignoring others. Even the development of the index itself, it requires active decisions. So it's almost like, take it one step further, rules based versus non rules based. That's almost how the universe to me breaks out, because you could, even some active managers themselves could be running a rules-based process, but be deemed an active manager because they have the ability to have that discretion. So, as when we talk about the AI space, I'll explain how that ties into what we do. But, I think having a rules-based process, whether it's an actual index or just a rules-based process without the index, I think there's benefit there for investors because, at least in my opinion, I like to be transparent with the investors. To me, investors should know exactly why a certain security is in your portfolio or not. I'm not that excited about, these, quote, genius portfolio managers who are just picking stocks. Now, of course, they all have their process on the back end as well.
Right.
They're not just waking up in the morning, but I thought you probably saw the most recent data. I forgot who published it. Was it the Wall Street Journal? The SPIVA numbers, where these portfolio managers do not beat the benchmarks. They cannot beat the benchmarks in the large cap space. There's just too much information there. They have a better shot in the small cap space, but even there, it's a 50-50 toss up whether they're gonna win or not. So to me, I think I think the future, and I think we're seeing this now, is a rules-based process. And if you're an active manager, you could still have the discretion to overweight or underweight around that rules-based process. I think to me, that makes the most sense.
Yeah, no, it's really interesting. And just going, you pulled on this thread a little bit. Active managers, or at least good active managers and good firms, have strong, mature processes. And so an active manager on Wall Street is not going, oh, I see this today, let's buy it. Oh, I see that today, let's sell it. There should be some structure to it. If there are technical traders, it's like, okay, this did, whatever shape in technicals, which are all based on psychology, and say, okay, there's a head and shoulders, I'm going to sell out of my position or whatever. And then always the problem with us humans collectively is that sometimes we justify things that aren't necessarily right. Like, oh, it's almost a head and shoulders, I'm just going to sell ahead, even though it's not in the process. So that's where you have risk managers, and that's where you also have like kind of indices. It's interesting because I think you definitely answered technically accurately that question, but I also want to kind of dig in right before we kind of get to the AI conversation on, and I think you commented on this a little bit in your answer, in that we have S&P 500, which is a very simple index. You have active managers who, I agree with you, are not necessarily transparent, and maybe have very complicated processes, or by the way, it could be really simplistic. But then you have, I find, this esoteric area in the middle where you could have an incredibly complicated recipe. And that, to me, doesn't necessarily, and you're the industry inside, so you correct me where I'm wrong, but it doesn't necessarily feel like, I'll call it a simple passive. And we were talking before the show that was like, some people used to call it smart beta. Could you speak a little bit to that?
Yeah.
I think it's an important element of the
Yeah,
industry.
smart beta was a term, I guess. I don't know if it's used anymore, but the Fortune 500 was actually the first smart beta ETF index, because it was basically anything non-market cap weighted was smart beta. But then they got into other things, and actually PowerShares, Bruce Bond over at PowerShares, he really had the first indexes that were, I guess, really the first real smart beta indexes when he came out with the Intellidexes. I don't know if you remember those way back when he started PowerShares. And they were very multi-factor models that were, I don't know if they were monthly or quarterly rebalance type products, but they were very, multi-factors, and it was rules-based, but they were complicated. So, it was really an active process baked into an index. And that really changed the game in the ETF market. And then, of course, Wisdom Tree came out with their dividend-focused products, which, again, another flavor of smart beta, much more simple, but still smart beta, non-market cap weighted. They were weighted by dividends. So there's so many different flavors of those that I guess the smart beta term doesn't really mean anything anymore, because everyone's kind of doing something that's not market cap weighted. And if you are just market cap weighted, then you're just a regular index.
Yeah, that's right. I think that's fair. And I'm going to pick on, like, multi-factor is the best place to go. And for people who don't know what any factors are. I'll give you one. One factor is momentum. And what momentum means is if a security moves up over some period, it has momentum. If it continues moving up, that's better momentum. So let's buy the ones who have good up momentum and not buy the ones that have bad upward, like maybe are going down.
Yeah.
So that's an example of something. And so now all of a sudden, you have somebody who says, I want exposure to generally the US markets. And this thing may have, there's a term called tracking error, which is how far away your performance may be, up or down. It could be tracking error, it could be a positive number, but like how far is this going to diverge from what everybody's watching? And everybody's watching, it used to be Dow, and now I think it's really S&P. And it's like, how far will that diverge? The more you throw into the recipe, the more it's going to diverge. So
Yep.
that's one thing that's really important to understand. It's like, what is the methodology? Great, it's an index. That does not mean safe. Okay,
Right.
we'll just stop there. And then the second part is, which is a real innovation of ETFs, I think, even though you could have done this in a mutual fund, is being able to really get very, very tight on an exposure. So meaning I'm in tech and I have broad tech exposure. Okay, now I have just hardware. Okay, so now I don't have tech exposure, I have hardware exposure or semiconductor exposure, and you get extremely narrow to the point where now there's ETFs on like old age, right? I think there's some old age, like something that plays the old age theme. America's getting older, so you could buy an ETF that tries to give you that exposure, which is really interesting, but becomes way more complex. Is that?
Yeah, I mean, ETFs are really good at allowing investors to express their views of the market. I think that is probably the best feature from an investor perspective. But, I just investors need to be very educated and careful. To your point earlier, you don't want to be expressing your views in the market with the majority of your portfolio. You want to have a nice diversified core portfolio. Then if you want to overweight or underweight certain themes that you feel are important or not important, go for it. But, it should be a smaller piece of the pie. And that's what I always counsel, anybody I speak to. You gotta know what you're buying. And the problem, and look, I love the ETF market. I love the industry. But one thing that's always angered me about the industry is it's very marketing driven, which I guess, any financial services business, I guess is. I'm sure the mutual fund market is similar. But I don't know. There's a lot of labeling issues and marketing issues where, a product is developed, the name's slapped on it, it's pushed out, and it has nothing to do with the theme or what the exposure is that it's ostensibly supposed to have. And that is just unfair. So I think, caveat emptor, right? I mean, the investors need to pay attention to what they're buying. It's critical.
Yeah, no, I think that's exactly right. And I think what we've just discussed really provides a great framework, but I want to put a positive spin because I think it is positive. Right after you gave a very important message to the audience of, ETFs allow you to get really granular with exposures and get access to something that previously has just not been accessible. People could get it, but just not retail investors, not advisors, it just wasn't available. So this is a real huge benefit. And now I really want to get more targeted with that framework of, the ETF industry on AI. It's a hot topic. I think it's the first product you guys launched, correct me if I'm wrong,
Yes.
back in December at Vistashares. So again, congratulations on that and exposure to AI. It's a relatively new technology. How does one get exposure to AI?
So the genesis of this product and really of Vistashares is my partner, John McNeil. So John McNeil was the president of Tesla. He was a chief operating officer over at Lyft. He's on the board of General Motors. He's vice chair of their autonomous vehicle division. He's a brilliant technologist, absolutely brilliant, and a brilliant businessman. And he was trying to find ways to invest in these various super cycles that he's identified, AI being the premier one that we've focused on first. And what he recognized is really going back to what I just said about marketing. When you look under the hood of the products that are in the market, Those are not AI products. They are just not. You know, you look at the biggest ones, it's the Mag 7 for 30-40% of your exposure. And, you know, and they charge 68 basis points for it instead of just buying a broad index-based product like the Qs or S&P for getting most of that exposure. So, you know, it's their build is something, but they're not. So he saw that and he said, wait a minute, there's got to be a better way. So he put his and his research team put their heads together to come up with a better way to get exposure to AI. And it's very intuitive. So, you know, our product is an active ETF. It's active to a rules-based process, fully transparent rules-based process. And what his premise was that particularly in today's environment with AI, where you see hundreds and hundreds of billions of dollars of CapEx being invested, where is that money going? It's going into infrastructure. So, you know, everyone wants to talk about the chat GPTs and the DeepSeeks, and those are all front-end consumer-facing applications. There's no revenue model on those at this point. 3 to 5 years from now, perhaps, but not now. Where the dollars are being invested is the infrastructure. So when you analyze the supply chain of AI, you find that there's two important parts of the supply chain. There's the data centers and there's the semiconductors. Okay, step one, we figured that out. Now what do? We analyze all the different segments of the supply chain to determine, you know, what goes into building an AI data center, for instance. What are all the components? It's racks, it's fiber optic cable, it's cooling systems. You know, all these non-sexy kind of picks and shovels type companies that are, you know, under the radar for most investors. So once you identify and map out the supply chain, then his next step was, all right, let's overlay the bill of materials on top of the supply chain to determine what are the most important segments of the supply chain. So you'll overlay that and you find that, you know, cooling systems, for instance, is 30% of the cost of an AI data center. Whoa, that's interesting. There's a lot of money going into cooling systems. We should look at that. So then you identify the companies that are each segment. And then the hard part is really to analyze the companies to determine, all right, just because a company is in the cooling business, and even if they're building data centers, doesn't mean they're building AI data centers. It's a whole different business. So you got to analyze their financials, which is time consuming and you know, it's a lot of work to determine where's the AI revenue coming from. And that's really the core of the portfolio. For us, it's a rules-based, transparent process. The key, though, for us, and we think is very important in a dynamic industry like AI, or in any of these other, you know, fast-paced, you know, a biotech or robotics, any of these really fast-paced industries where there's a lot of change, you need to have expertise at the helm to, you know, oversee the portfolio from a risk perspective. So we developed an investment committee that oversees our core portfolio. So we have we do it very differently. We have what's called our practitioners and then our portfolio construction people. So our practitioners are John McNeil and this guy, Sonny Madra. Sonny is the president of Grok, which is one of the premier privately held AI companies in the world. They've been both in the AI business since the beginning. They understand the supply chain. They understand the players. They can identify risks and opportunities, hopefully before most people can. Once they identify a risk or an opportunity, then it goes over to the portfolio construction side, which is myself and Professor Robert Whitelaw, who is the former dean of NYU Stern School of Business, chairman of the finance department, brilliant portfolio construction expert. So, and that's what we do. So we have the core portfolio to get you that exposure to the infrastructure, which is where all the profit pools are now. And then we have the investment committee expertise to oversee, to make sure, you know, to the best of our ability, we're identifying risks and opportunities as early as possible.
Got you. And so that's driven by revenue, AI associated revenue. Is that how the selection process is driven?
Well, first it's the supply chain, then it's the bill of materials, then it's mapping the companies, and only then we're digging into the revenue of the companies to determine which ones are most applicable for AI. Are they getting AI projects?
And then if you have $100 million of revenue for a firm and 80 million of it is AI, are you kind of doing that revenue based on 80 million or 100 million?
That's a great question. So um, let's take power and cooling just as an example. I'm
Sure.
just trying to
Yeah, yeah.
illustrate it for the listeners because it's hard to.
Yeah, yeah.
Um, let's say there's four companies in there that are in that segment, and each one of them, we're looking for at least 30% of their revenue coming from AI. We want it
Okay.
higher, but it's such an early stage industry. You can't. It's hard to find companies with much higher. Some of them have 50, but 30 is our threshold. So let's say there's $100 million in total AI revenue in that bucket. One of the companies has 50 million of it. They're getting half the allocation in the power and cooling segment. And the other three are being split by their revenue. So it's market share weighted within each segment of the supply chain.
Okay. And then power and computing. Are you saying, is there a maximum or minimum exposure that you have to power and computing? Or is it kind of the same way where it's like, okay, there's 100 million here and there's a billion in chips, so it's going to get 10%, a little less than that,
So the
9%?
way we do that is we have the two supply chains. One is the semiconductor supply chain and one is the data center. I'm just using the data center supply chain. So power and
Okay.
cooling is around 30% of the total cost of an AI data center. So they
Okay.
are getting a 30% allocation in that on that portion of the portfolio. So then it runs down. So power and cooling is the largest, and it goes down, racks and fiber optic cable, and it kind of goes down all the way down to the bottom. So power and cooling will get a higher portion of the portfolio than racks, which is 8% of the cost.
Got you. Okay, that's really helpful, and especially because I want to kind of go back. When you answer that, you mentioned that a lot of indices have used, as an example, the Mag 7, the Magnificent Seven. I'm not going to rattle all the names off. It's like Apple, Amazon, it's everything that's kind of driven the market a bit. Bless you. And when you kind of going back to like the example Adam just used, another example I'll make up because one of the Mag 7's Apple, and they're like, oh, guess what? Apple's going to come out with AI on their next phone, and therefore Apple is an AI play. Okay, sure. I mean, so is Fountainhead. We're using AI, invest in us. Like, I don't know what to say. Like, everybody's using AI, and it just comes down to, you can make a better case, by the way, for Amazon because Amazon's one of the largest cloud computing companies in the world. Now,
Yes.
Amazon's really complicated because they have so many businesses, and so it just kind of like it highlights the complexity of all of it, but it also highlights just kind of being careful, right? Because Tesla, going back, one of your, it's like Tesla has an AI component to it. Are you investing in Tesla based on the cars, or are you investing in Tesla because they have some technology that they're going to be able to kind of have almost real time on every single road and be able to have automated driving? So
Yep.
it's always complicated, but and this drives it home. So Adam, I would say, and please correct me if I'm wrong, but I would say that your ETF is broad-based. You're looking to provide broad-based AI exposure. Is that a fair statement?
To the infrastructure of the AI industry globally. Absolutely.
Okay, so now you just said infrastructure. So is it more, well, it's broad-based, but is it a infrastructure-focused AI ETF? In other
Oh,
words,
yeah.
if I wanted some other
100%.
exposure?
No,
Okay,
it's
fine.
100% AI. It's infrastructure focused. We are only looking at the data center supply chain and the semiconductor supply chain. That's the infrastructure for the. So when Apple says they're going to invest $100 billion in capex, that's exactly where it's going. It's going into the data centers and semiconductors. So I mean, I'll just give you a very high level, silly thing I say. When when Apple puts in $100 billion for infrastructure, we want to hear the cash register ring across our entire portfolio. That's where all the money's going. That's where the profit pools are now. So yeah, Apple. You could call Apple an AI company, sure. They're not making any money on AI right now. They're a consumer-facing application company that we have the ability to add a supply chain later for consumer-facing applications, but we're 3 to 5 years away from that, as far as I'm concerned. You know, to get to that point, the data centers and semiconductors have got to get more powerful and more prevalent to create the more powerful large language models So that, and then the business models need to be built around those to drive incremental revenue to the bottom line. So right now the play is the infrastructure.
Okay. Are there any other? So you're saying some of these other. So I'm gonna say AI is broad, right? There's lots of areas, and then infrastructure is a subsector of AI. Are there other investable subsectors of AI right now in your view?
No, I really don't. I really don't. I mean, and I'm taking from a high level, so to me, and I'm simplifying it. I mean, we can
No,
get
it's
more
fine.
granular. I
Yeah,
don't
yeah,
want to, bore you, but it's data
yeah. Go
centers,
for it.
semiconductors, and consumer-facing applications. That is AI. There's no, because every single subsector we could rattle off right now would be part of one of those three. So it's really three different segments. We are ignoring the consumer facing applications because that's the Mag 7, and that's not where the money is right now. The money is in the data centers and the semiconductors, in our opinion.
Got you. So yeah, so you just mentioned, right? So consumer facing AI. Um, so would you distinguish on consumer facing AI between something like a Chat GPT, or like a Morphus or any of these others, which I think are all impossible to invest in, at least on public markets at the moment, and um, applications, or I guess it's all consumer face. Or like I'll give the example, like the Tesla car and some AI element built into the vehicle.
No, we won't have exposure to any of those. Generally speaking, we do have some software players because
Okay,
they're players in the data center or in the semiconductor supply chain. But a chat GPT, if it was a public company, would not be have exposure because that's a consumer facing company. So, we will have, there are software companies that are important for running AI data centers. So we will have those in the portfolio for sure. But, but yeah, I mean, it's just it's a very early stage industry, and the infrastructure needs to be built out significantly for it to become this transformational industry that everyone's talking about. And we're early on there.
got you. And so within, we kind of opened up this episode by speaking about there being, I believe, 24. My numbers might be off, but around 24 AI related ETFs. Are most of them broad in your opinion? Like kind of trying to get with the Mag 7, with infrastructure, with everything, maybe paint us a little bit of a general picture of that.
Yeah, I mean, I track 18 of them. I'll look for the other six, but excuse me. Most of them are carbon copies of each other. There's a couple
Okay.
that look a little different, but most of them are very similar with the
Eh,
Mag 7 exposure.
got you. And then with all them being relatively similar, it just comes down to looking at that index methodology and kind of understanding where they differ in terms of why one has 5% versus 6% of a specific position. Fair?
Yeah, absolutely, because they do have different rule books and they're getting different exposures from that for sure. But if you look at the top 10 holdings, most of them mirror each other.
Got you. Got
Excuse me.
you. No, no worries, no worries. Colds are difficult.
Yeah, I
So
apologize.
feel better. It's all good. Okay, so what? So that was really helpful. I think what we really gone down to is the framework of just some big picture items to think about when navigating and thinking about how do I invest, which ETF should I purchase, some of the characteristics of it, and then a little bit of a deep dive on AI, which is really interesting. But you're exactly right. It's one of those things where AI is so exciting. It's really being used by people. Um, the youngsters are using it in school beneficially, and maybe
Yep.
maybe even beyond beneficially.
Yeah.
Um, most firms, I know our firm's actively using it and looking at it and taking advantage of it. So it's really really exciting. But as you said, it's early days, um, and I think there's a lot of pitfalls there in terms of like these companies are not necessarily public. They're not necessarily name brands. How do you access exposure, right? That's the questions we should be asking, right?
I agree, and we think the boring ones are actually more interesting now than the flashy ones because everyone knows what the flashy ones are. They've been bid up already to tremendous multiples. It's the boring ones, the ones that are building the racks for the data centers. Corning, for instance. Did you know that Corning is the largest producer of AI fiber optic cable? You might know that, but most people
Yeah,
wouldn't. So I mean, it's
because
those
of dot-com crash. They were in
right.
2001. They went crazy in the in late 90s. Corning was like out of control.
I
It's like a
remember.
glass company, but they have fiber optics and that. So, yeah, sorry about that.
Yeah, I
Keep on
remember.
going.
But
Yeah.
yeah, so it's those type of companies that people might not recognize have a significant equity revenue stake in this growth area. It's the picks and shovels. I mean, it's such an overused term, but it's really the truth here because those are the companies that are getting all this investment right now and where all the profits are being made right now and for the foreseeable future as well.
Yeah. Yeah. Can you give us, if you got it off the top, if you could rattle it off the top of your head, 2 to 4 bullets on what to look for when you have someone going into an ETF? Like, what are things they should check out before
Well,
making an investment?
first thing is the methodology. You want to what we talked about earlier. Look at the
Correct.
methodology. If it's an index product, read the index methodology guide. They're all publicly available. So, a lot of it. There's a lot of numbers in there and things like that. But you don't even need to worry about the calculations. You just look at what they're doing. Are they searching by SIC codes? What are their screens? How do they weight them? How often do they rebalance? I think that's important to understand that. So you have a better sense of what you're actually buying. The second is based on the methodology, what portfolio are you getting, and is it worth what you're paying for it? So fees are all over the place in the ETF market, but if you're paying 68 basis points for basically Mag 7 exposure for 35% of your portfolio, probably not worth it. Go buy the broad indexes and get that for 10 bips. So I think you need to, pay attention to that as well. Um, yeah, and then of course, look, trading volume is always something to look at, and I don't mean trading volume from a perspective of can I buy it, but is it a healthy product? Is it a healthy product? Has it been around for 7 years and doesn't trade? you know, if it's a new product, look, our products are new and they're trading nicely, but they're not trading like, these big products are, but they're brand new. They're healthy. But you want to really get a sense of that, I think, as well, which would be important.
No, that's fair. That's fair. So methodology, exposure, fees, and general health of the
Yeah.
provider and just the markets.
Yeah.
Really good.
So,
All right. So here's the final question for you.
oh,
You're the pioneer. You're the insider. Where are we going? Give us a vision for ETF world over the next 2 to 5 years.
God, I mean, the reason why I wanted to get back in, everyone said, oh, it's so competitive now. It's a whole different business. It is a lot more competitive, but there's so much white space out there. There's so much white space. I mean, there's so much room for innovation that gets me excited. I mean, one thing I think, and we just launched a product last week based on this, but I think options income is a really exciting area. We have a whole family of those that will be coming out, but it's not brand new, but it's fairly new, and it's a really interesting way to give investors some kind of core equity exposure, but with a little bit more income, which in volatile markets could be beneficial. So I like that whole area. And there's a lot of new innovations going on in the fund to fund space as well, which you got to be careful there because you're doubling up fees. But if they're constructed properly for specific outcomes, it's almost like a one-stop shop model where you can, put a big chunk of your capital to work and not have to worry about things, which is nice.
Yeah, no, that's great. That's great, and it goes with the general themes that I think have happened over the years, which is you have financial innovation. Wall Street's amazing at financial innovation. Financial innovation helps. It's supposed to help. Um, it's supposed to help Main Street. Doesn't always do that, but it's supposed to
Yeah.
help Main Street in terms of let's say getting lower insurance costs, all these great financial elements like having a credit card, which you could slap down anywhere and not recognize that there's a fee there, and all these great things. They package them up and then they create these great innovations for the end investor. So now we have way, way more access and way, way more vehicles, and it all comes at the price of complexity. It comes at the price of complexity, but I think I think it's a broad positive. Adam, good luck with Vistashares. You're doing exciting things, and thank you very much for coming on the show. It was great having you.
Well, thanks for having me. It was a lot of fun. I'm sorry for coughing for the last 15 minutes.
No, I feel better.
I appreciate it. Have a great day.
If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast@fountainheadam.com. Thank you to Fedi Smooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.